Welcome back to the Hot Mic series. I'm Larry McDonald, and I've got a special guest here today, Jared Dillian, best-selling author, and most of all, everybody reads the Dirtnap. A lot of our clients around the world are friends with Jared and rely on his insights on the market, great writing style, former Lehman trader like I am. So I'm looking forward to have this conversation around Archegos, kind of leveraging the system. Jared, let's kick it off. First of all, let's go back just a little bit. Tell us about your background, how you got to this point in time. It's been an incredible career path, because I remember being at Lehman on the trading floor, and when I first met you, what they would do is they would bring some of the senior traders from around the firm to meet different silos within the firm. And I was over in the fixed income division, trading convertible bonds and high yield distressed debt. And Jared would come in and speak to us about the ETF universe. And Jared was this senior trader in the ETF equity side. And to go from there to best-selling author to now you have your own podcast, your own radio show, and the Dirtnap is it's extremely widely read around the world, as far as I can tell. Which is and the great accolades from a lot of the people that I speak with.
Thanks. Yeah, I mean, we work together. I actually, we have a couple of funny stories we could tell if you want.
Yeah.
But there's I actually started my career on an options floor. I started on the P Coast, and I was there for about a year and a half. And that's when I was in business school. I was working part-time. And that's kind of how I got the job at Lehman. And when I started at Lehman, I started off doing index arb. This was in 2001. So it was still done by hand. It was still done manually, and it was becoming more electronic. And I kind of, this was a runoff business for Lehman, and did that for a couple of years. And then they made me the head of ETF trading. When I took it over in 2004, it was a pretty small business. When I left in 2008, it was a pretty big business. And this is in the mid 2000s. So, people were using ETFs for way different purposes back then. It was mostly a hedge fund trading vehicle. The ETFs weren't gathering assets. They went through this period of time in the 2000s where they didn't gather any assets at all. And it was basically just people day trading in and out of ETFs. And I was kind of on the receiving end of that. And that job was one of the craziest things I've ever done. Just in terms of the amount of flow and the volatility and the people trying to pick you off.
Yeah. So let's kind of bring this out. So you were trading, essentially making markets for primarily institutional investors. So you're getting in between, the more capitals of the world and your BlackRocks potentially. I mean, but in between buy-side desks trying to hedge their portfolios.
Yeah, I mean, there was definitely some hedging, but there was also a lot of speculation. People just trading stuff around. A lot of the fast hedge funds that you used to hear about in the 2000s, those are my clients. So we used to lose a lot of money to those guys.
Well, I remember one time there was an incident on the trading floor where there was a technical glitch, and we were having a great day on in our little department. We were up like $3 or $4 million, and in my book, and then this technical glitch came along around an ETF, and I literally, like 5 minutes later, maybe 10 minutes, I was looking at I think around a $600,000 loss on this ETF position because of a technical glitch. And that's when I really got to know you, and it became your best friend, because I literally, myself and my boss, Rich Gatward, went over to you and said, Jared, can you trade us out of this position? And my God in heaven, over the next day, especially like 5-6 hours to maybe 14 hours later, you had taken that, I think, from like $600,000 loss to around 180,000, which was, to me, just, I was the happiest guy on the desk. And to this day, I want to thank you. And I might name my next child after you.
That was XRT. And what happened is that you hit the buy button on the trading app and it stuck.
Yeah.
And it was, so you hit like the buy 1,000 shares button or something and it stuck, and it just was like rapid fire buying XRT. So it was trading at a huge premium, and like, it ripped up like $2. And
You can still see it on the chart. If you pull it up on Bloomberg that day, I think it was I still look at it once in a while. It was the summer of 2007, right?
yeah.
And if you look at it on the chart, it is unbelievable. And when you look at the chart, you can see the job that you did trading out of it.
Yeah, that was cool. Yeah, good times. But anyway, so then, Lehman went bankrupt and I started the Daily Dirtnap. This was back in 2008. So I've been doing it for the last 13 years. And, it's been great because I don't market it. It's grown just by word of mouth. And the word of mouth is very powerful. It continues to get bigger all the time. I've written a couple of books. And I have a radio show now. A lot of people say, oh, you have a podcast. I'm like, no, it's not a podcast. It's actually live radio. I'm on the radio 2 hours a night, every night. I'm on 23 stations. It's a nationally syndicated show.
Okay.
So, and yeah, in my spare time, I do music, and I'm actually getting a master's in fine arts and creative writing.
Yeah, that was the thing that I think you and I, especially you, because I think when I wrote our book with Patrick Robinson, I really had to rely on, he had just written Lone Survivor, which was a #1 New York Times bestseller. And I went to him with this Lehman book project, and he taught me how to write. We worked together for 6 months, almost 24/7. He taught me how to write, but you were self-taught. And I remember, reading your notes on the trading floor, and the thought that you put into it is very unusual. You meet someone that has, a thoughtful writing style and that understands, markets that well. I mean, it's usually one of the two. Financial literature is pretty ugly when it comes to actual writing style. And I think you were the first one first person I saw that could actually, do both tasks at once. But your skill set today for this Archegos situation is just perfect. You're the perfect person to talk to because, I think you and I, especially you know a lot of these players behind the scenes. And here's the thing that blows me away. The rehypothecation scam goes back, literally decades. And I remember playing golf in the club championship in I think the early 90s. And I was playing against this guy. I won't mention any names, but we're on the putting green, and then this police car came up to the putting green, and the sergeant got up. He walked up toward us. I was like, "Oh my God, what's happening here?" And he went up to one of the players on the green, and they had a conversation. Next thing you know, they took him away, and it turns out his father had given him a $70,000 MG. I think back then it was like a really cool sports car. And he'd taken it to about 6 different banks. And he loaned basically a $70,000 car, and he borrowed 20 grand or 30 grand from 6 banks against the same vehicle. And this is the rehypothecation. And what's amazing is this scam has been going on for decades. And here we are in 2021, and we have the largest banks in the world were essentially hit with a very similar same rehypothecation scam. How does that happen, Jared?
Well, a prime broker is like a clearinghouse that's internal to a bank. And, a large hedge fund can have a number of prime brokers. So if you have a hedge fund that is doing swap business with a bank, I mean, there's counterparty risk for sure. So you have credit people at the bank that sort of examine this and say, is this a good credit risk? And then when they put the trades on, they say, okay, from a market standpoint, how much margin should we extend and stuff like that. So there's people at the bank that make these credit and margin decisions. But the problem is that they don't have knowledge of what the client is doing at other banks. And that was never a problem until it was a problem, right? Like it never was an issue until now. The amount of leverage that Archegos had was staggering. But swaps are not exotic derivatives. I mean,
And these are total return swaps.
yeah, they're just plain vanilla, just total return swaps. So like Viacom, for example, you want to get a swap on like 20 million shares of Viacom. Basically, the client receives the return on Viacom. The bank hedges by actually buying Viacom. So they'll buy 20 million shares. And the client pays a floating rate. And it's very plain vanilla. There is a lot of leverage, and these things are marked to market on a daily basis. So if the position goes in the client's favor, the bank wires money. If the position goes in the bank's favor, the client wires money. It's kind of like a futures clearinghouse. It's all done manually, and I don't know what precipitated this. I don't know if the client stopped making margin calls, or if I don't know what precipitated this, but eventually they made the decision to blow out these positions.
And we're talking about potentially a 12 billion loss across 6 or 7 institutions, with, unfortunately, the way Wall Street works, there'll be 1 or 2 institutions that ended up holding most of the bag versus I have a theory, as a former convertible bond trader, the things you see in converts are just fascinating, because when CFOs come in to do transactions, typically they're very good sellers. And in the convertible bond market, last week I was blown away because I was watching Viacom stock, and I'm thinking, my God, somebody's going to come in here and probably do a convert. And lo and behold, Bob Backish comes in, CEO of Viacom, and does a mandatory convertible and a straight stock selling, I think on an overnight transaction. So that means that the bankers, either Goldman and Morgan Stanley, the bankers had privy knowledge about the situation, right? So the question is, it's supposed to be a Chinese wall. Does that information leak over to the sales side? Salespeople can protect their clients, because you're talking about a stock that was up, 100% or 75% on the year, and talking about a stock that went from 14 or so during the depth of the crisis to 100, and from 40 to 100 in the last couple of months. So all of a sudden, here comes this overnight transaction of $3 billion worth of equity. The entire market cap of the stock in March of 2020 was $7 billion. They're selling $3 billion worth. I mean, just a pretty large amount of equity. And there was a number of things that Archegos was involved in, right? Baidu and a lot of these Asian equities, Asian-based companies in China and Japan and China and parts of Asia. But this transaction, I don't know if it's that convertible bond, that mandatory convert, that so much came on the market for sale that something triggered that decline, and then that reversal in Viacom. One of those things triggered Goldman and Morgan to come in and start the unwind process. But it takes a lot, doesn't it, Jared, to rip up an ISDA contract? In other words, an ISDA is like a relationship between a bank and a client, and for them to rip that up and just liquidate the portfolio, that's a lot easier to do with total return swaps versus a traditional account. Is that correct?
Oh, I have no idea about that. Keep in mind, I was in a listed business. I was in the ETF business, so we didn't deal with ISDAs. I don't have any experience with that. I can't speculate about that. I don't know.
Okay. Well, yeah, we do know that they just, essentially just liquidated the accounts. And total return swaps, we also know that total return swaps, extremely profitable business for the prime brokerage part of modern finance. And then we also know that the commissions generated from Archegos must have been impressive around the street. So this is a big commission business. Client essentially had maybe 10 to 15 billion of assets, and he levered that up to potentially 100, who knows, but that's reported by Fox potentially.
Yeah, it had to be one of the most profitable prime brokerage clients. I mean, if you think about this, there's basically 2 ways that prime brokerages make money off of this. And one is by the financing spread, because they're receiving a rate higher than the rate at which they fund the firm. So there's a spread. So they make 30, 40, 50 basis points, something like that. And you magnify that over 100 billion, and it turns out to be a lot. And the other part of this is that, let's say you're talking about maybe not an individual name, but a basket of stocks, whether it's a custom basket or an index or something like that. If you get a swap on an index or a custom basket, the bank hedges by buying the basket of stock, which they can then lend out to shorts, right? So they make money off it both ways. I mean, that's, when I was doing index arb at Lehman, a lot of the money we made in index arb was actually on the financing side, because we were short like 7 billion worth of S&P futures, and we were long this big basket of stock. And then equity finance would lend out the stock, and we would make money that way. So,
yeah, so it's greed on steroids, because it's really profitable for the bank and the prime brokerage part of the bank, and it's really profitable for, if you're a hedge fund or family office, you lever that up. If you're making 1% levered up 10 times, it's 10%, but a 10% return levered up 10 times is 100% return. So you can just imagine. And then, just the testosterone of the thing that really boils me in my blood is like some of these companies that, really have horrible balance sheets, and some of the best short sellers that I respect. I mean, some of the best in the business that were short a few of these stocks, and they're going up against an opponent here. And this is probably just one of many opponents that can hide their positions through total return swaps. So there's no visibility as to where this buying is coming from, because the buyer, whoever's doing these total return swaps, whether it be Archegos or somebody else, can lever up their cash pool from, say, 10 billion to potentially 100. You can just go after a really crappy company and just try to create a short squeeze and manipulate the market higher, and then try to push people out. It's an ultimate game of Goliath versus Goliath, but the media portrayed this as David versus Goliath, didn't they?
I guess.
Not this. I'm talking about Robin Hood situation, but
oh yeah. Here's the point I want to make. I think nobody is picking up on this. Okay. It's not about really. The less interesting part is about the relationship between the hedge fund and the bank and all that stuff. I'm looking at the overall market significance of this. So we're in a bubble. Okay, it's demonstrably a bubble, and bubbles don't end on valuation, because there's no ceiling on valuation. It can just keep going higher. So it doesn't really matter how expensive stocks get. That's not the trigger for the end of the bull market. The trigger for the end of a bull market is when a large leveraged player gets taken out, right? And that happened in 2008. It happened in 2000. And this is an example of that. I mean, this is, a tiger cub that was imitating a lot of the SoftBank trades. It's not SoftBank, but it was imitating a lot of the SoftBank trades. Super, super leveraged on the highs. All it takes is a small downtick, and they're wiped out. And then basically the marginal buyer of all these tech and media stocks is taken out. And that's literally how bear markets start. There's a lot of precedent for this.
yeah, and it's Larry McCarthy used to say at Lehman on the trading floor, higher prices bring out buyers, lower prices bring out sellers, but size opens eyes, right? That was a great quote that he used to have. And as your point is, so picture what's been happening over the last couple of months. Behind the scenes, we know 1 to maybe 10 of these leveraged weaponry, leverage piles of weaponry, including Archegos and the others, were driving these stocks. What happens is Wall Street analysts see the stock prices going higher. They upgrade, right? They never upgrade on the lows. They upgrade on the highs. That brings in more retail buying. And to your point, if the street now can't trust, and this is what I think you're getting at, if the street, if you're a hedge fund and you can't trust your own prime broker, then there may be some type of deleveraging. Like right now, I would imagine as we speak at this very moment, across all the top 25 to 50 hedge funds, across maybe the top 200, you just have massive compliance meetings right now around what happened, how could it happen, could this happen to us? And so it just naturally leads to possibly a deleveraging. And then to your point, that takes away that marginal buyer that drove us to these points.
Exactly. You nailed it. Yeah. I mean, it's really a discussion about risk within the prime broker, because now everybody's eyes are open about, like, gosh, this is the business we're doing with this hedge fund, but what kind of business are they doing away, and how do we account for that? So that's really the question that needs to be answered.
Exactly. And then the most entertaining part of this is when Elizabeth Warren gets on this stage. I mean, it's going to be, they already had the Robinhood. So this is could you do me a favor, tie these two together? Because the Robinhood situation was a broker dealer and this is the way I understand it, correct me if I'm wrong, a broker dealer that took on maybe 3 or 4 million accounts in a short period of time, Robinhood. They had so many people buying options and equities on a few stocks that their internal risk models couldn't calculate the risk. And so at some point, the group of piranhas, the group of buyers was so wide and so large because of social media that they had to stop the buying because their models couldn't calculate how much capital they would have to put up against client positions. And so that's the way I understand it. But let's bring this together for a sec. So in the last 60 days, we have a blow up of Robinhood, which was a substantial amount of retail people buying things on leverage and options that eventually forced Robinhood to have to raise capital. I think they raised a couple billion, and they obviously didn't have the swap lines. They didn't have the backup financing mechanism set up because they had to go out in the public markets and raise the money. So that's a leverage blow up with Melvin and Robinhood, and then all the other players there with the upside options that we know. And you've been writing about the option volume, the single retail option volume over the last 3 months. And now we have this. So what does that tell you? What's the connectivity between the two?
The connectivity is leverage. It's too much leverage in the system. It's that simple. And I don't know exactly what Melvin's leverage was. They were leveraged, but that magnified the losses, and all the other hedge funds on the wrong side of GameStop. I mean, if you're running a market neutral hedge fund, you use leverage, right? So this is the discussion that's happening at hedge funds across the country is, the use of leverage, because leverage works both ways. So I actually have I have a good friend, used to work at Lehman. He's at an asset manager now. And when he left Lehman, he worked at another asset manager. And this was in 2006. But his boss once said to him, she said, "Let the leverage generate the alpha." And that place doesn't exist anymore. That place doesn't exist. But that's kind of the attitude. I don't want to like paint a broad picture about the buy side, but that is kind of the attitude of like using leverage to magnify your returns. I mean, people are going to have to take a hard look at that.
And that's not a scary thing, but kind of like the despicable thing about this is like, okay, so central banks are in a tough spot because we're trying to come out of a near depression scare. Obviously, GDP in the United States is we're having a big recap this year. The street's looking for 6 to 8% GDP bounce. But central bankers, through this extremely accommodative policy, have forged a moral hazard foundation that is bringing out like you said, is a tremendous amount of leverage. That's the side effects. And if you listen to the Fed conference calls, or obviously if you read the white papers, anything you do around the Fed in terms of they've been downplaying this leverage, number one. Number two, they claim that macroprudential regulation will solve this problem. Clearly, one of the things that I wrote about in my book, Colossal Failure of Common Sense, about Lehman, back then we had $50 billion a month. And as you well know, with Repo 105 that was going off the balance sheet. And then when they reported earnings, and then they would bring it back on. So Lehman and a lot of some of the other banks were probably doing the same thing. They were hiding leverage. So there we had 12 years ago, we had the banks, same thing, top cycle, hiding leverage, using leverage to juice returns. Now that leverage has been transformed over to the pretty much the buy side, which is, the asset managers that are using leverage to juice returns. Similar problem, 2007-8 leverage versus today. And, the regulators just are 3-4 steps behind. So, and then now we're looking at a social justice Fed that is promising, a lot more accommodation, right? So, the bottom line is if they stay very accommodative this year, just naturally one would think that we'll have more and more of these blow-ups, that they should get bigger and bigger.
Yeah, I mean, regulation doesn't solve this problem. It can try to solve the problem, but it will do so imperfectly. And what solves the problem is raising rates. I mean, you used to trade bonds. What's it like trading bonds when Fed funds is at 6%? Like it's a whole different ball game. When Fed funds is at 0, everybody's a genius. And it's tough to lever a market neutral fund up, 5-1 when Fed funds are at 4%. Like, so you raise rates and literally every problem in the world gets solved, including inequality, right? But like all of this can be solved by raising rates. Yeah.
And they've promised not to do that until 2023. So that's a long time from now. That's at the current pace, we'll have 17 Melvins and another 22 Archegos because it's only happened in 60 days. So as we look at the rest of the year, let's kind of wrap it up from a macro perspective, how you're looking at markets, any high conviction calls. One of the things that I've been in my mind, and working with ACG Analytics has been a great partner of ours in Washington. The Democrats are looking at the 2022 midterms, and you have a president in the seat now that was in the vice president seat when they lost 63 House seats in 2010. And so from everything I can gather from talking to ACG, behind the scenes, there's just a real vested interest in juicing as much spending through tricks like, this is almost like off-balance sheet tricks, but reconciliation is you only need 50 votes. It's a little bit like, an advanced political technique to pass legislation. And if they were able to get 2 reconciliation bills in 1 year, which it's never happened before, but we had one last month, and it looks like potentially we'll get one in the fourth quarter because you have to tie reconciliation to a budget year. And so I guess my point is, if you're the Democrats, you only have a 5 or 6 or 7 seat majority in the House. That the first midterm of every new presidential election, a new president in his first midterm going back 100 years, those results are pretty bad, including President Obama, 63 House seats in 2010. And what happened in that time is they lost the 63 seats in 2010 in the House. 2014, they lost 9 Senate seats. All of a sudden, it's austerity on steroids. And the Democrats are looking down the barrel of that history. And I think they're trying to put the pedal to the metal on spending. And how does that backdrop drive your thinking in terms of investing for this year and next year?
I think you're right, but the one part you're missing is what if the Democrats gain seats at the midterms? Hasn't happened in 100 years. There's no precedent for it, but what if it happens? I think it could happen. I think you could have 54, 55 Democrats in the Senate after the midterms. I think it's very possible. One of the reasons I say that is, we're kind of having bread and circuses, right? Like we're just handing out money. I mean, we're basically, I don't want to be cynical about it, but we're buying votes,
Sure.
And assuming that this continues over the next year and a half, I think it's very possible that the Democrats could get seats in the midterms.
Okay, I want to make something very clear. I'm glad you pointed that out, because I want to make something very clear. What I'm really saying is, and I appreciate that perspective because I didn't communicate properly. What I'm saying is, if you're Chuck Schumer, if you're Nancy Pelosi, if you're Joe Biden, they want to go so big that they do buy the votes, that they don't lose the midterms, 100%. So they want to go balls to the wall. And if they, last time in 2008-9, they did the 750 billion. I remember Geithner and Summers talking about with critical velocity, ho, 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 ha, 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 we're coming out of this thing, but it just wasn't enough. And, now I think it's like the Fed and the Democrat leadership lived through that austerity period. They lived through the mistakes of the Fed views the taper of 2013 mistake. So those two things, that austerity regime that came in because of the Republicans, and then the early Fed taper, those two combined created this deflation spiral, right? That just went into the next thing you know, there's a Brexit. Next thing you know, there's a trade war. Next thing you know, there's a COVID. Next thing you know, bonds are bid without, fourth quarter 2019, but even before COVID, and then bid without first quarter 2000. And what I mean, they bid without, massive amount of buyers, no offers on bonds. And now it feels like the whole thing is just shifting the other way in terms of that whole psychology from, deflation risk to inflation risk.
Yeah. I mean, there's a bunch of different permutations here. Even if the Republicans do pick up seats in 2022, a lot of these Republicans are not classical liberals. They're Trump Republicans. They like to spend money on certain things, so right now we have a deficit to GDP of about 15%. I doubt it gets down to 3%. It was at 2% around 2013-14 under Obama. The deficit actually got very small. It was around $350 billion. I don't think we're going to see that under any circumstances. So I think we have had a big secular shift to an inflation regime. You can see that everywhere. You can see it in commodity prices. We are in an inflation regime right now. And this is early innings, first or second inning. So I don't think it matters a lot what happens in 2022. I think that's going to continue into the future.
Okay, metals. Let's wrap it up with kind of like some big picture thing. A couple of things that we're working on is uranium and this infrastructure deal in terms of nuclear power, and as well as sexy metals around electric vehicles. The disconnect between the amount of people buying Tesla and where platinum and copper and silver are trading. Do you have any thoughts there in terms of this new infrastructure package, big themes for investing over the next year and a half?
Well, I think uranium is got to be one of the best ideas out there, for sure. And it's already moved a lot. One of the uranium names is in my portfolio in my newsletter. And that's, I believe in that trade. In terms of the metals, industrial metals, I mean, you're already seeing big moves. You're seeing big moves in steel and iron ore and stuff like that. I mean, that's as a result, the infrastructure package was just floated. So this has a long way to go. But even stuff outside of metals, the ags, corn was limit up yesterday. Soybeans were limit up yesterday. This is a broad-based commodity inflation. It's happening. It's going to happen.
Absolutely. I'm with you, and I'm with you on uranium. I'm with you on some of the uranium names. And if you just look at just the natural draw because of all this, there's really been a massive austerity period on the CapEx side. I mean, across all of commodities, which the 2016, when you talk to CFOs, and we talked to a lot in some of our trips and some of our calls, but CFOs in the commodity space, commodity metals, mining, they were just so burnt in 2016 with that horrific commodity bust. It was gold. I mean, oil bottomed out around $13, and then that's followed up by the COVID debacle. So so their decision making around taking risk in the uranium space is a perfect example. You had like 10, 15 years ago, you had a lot of people taking substantial risk. And
You there?
yeah, I just, it's weird. I lost the camera. Oh, okay. Well, we'll have to edit that out. But you had a lot of people taking, meaningful proprietary risk. And now all of those natural buyers and companies, the power plants that go out and buy uranium, they're buying from a very scared position, whereas those same buyers on the power plant side were buying from a proprietary position 12 years ago, taking risk on the upside and trying to capture upside. And now it's just facilitation. They're just trying to get by. And so once that psychology changes from the buying perspective, then it's a whole new ballgame.
I just want to talk a little bit about rates before we go.
Sure.
Because I think rates are really the key to this. Rates are going to go higher. Okay, we're going to, we did a $1.9 trillion stimulus. We're going to do $2.25 trillion infrastructure. We're going to do another stimulus later. We could have a deficit between $5 and $10 trillion this year. Interest rates are determined by supply and demand for bonds. That's it. A lot of people do all kinds of math about productivity and inflation and stuff like that. At the end of the day, it's literally just supply and demand for bonds. That's it. And we have a massive supply, and demand sucks because there is inflation. So these are unattractive assets, and rates are going to go higher. And if rates go higher, that's bad for tech. It's bad for growth. It's good for value. We made a secular shift from growth to value. If you go back to the first day that the Pfizer vaccine was announced, that was a 15 standard deviation day of value over growth, and it's been all value ever since.
That's a great point.
Ever since then, the whole portfolio for my newsletter is in value. The whole thing. I don't have one single growth stock. And I think that's going to continue for the next 3 to 5 years.
And you were the growth maven a couple of years back. You would love growth. Well, good. I love the shift because I'm with you there. And if what you said, if this backdrop of this conversation is true, which I think it is, then the Fed gets forced into yield curve control at some point this year because there's just not enough international buyers. I think the international buying ship of ownership of bonds, treasuries is down 15, 20%.
Yeah, actually, I remember you tweeted about it, all right? So I was like 10, 15 years ago, foreign ownership of treasuries was 43%. Now it's down to 29%. I got that from your tweet.
Thank you. You remember the number better than I do, but thank you. Yeah, so that means that if we do go into this, the last leg or the fifth, sixth, seventh inning of this spending spree, then the Fed gets pushed into yield curve control at some point this year. The clients in our chat, we have a Bloomberg chat with institutions, and they thought it would get triggered around 1.5 to 1 3/4 on 10s, just because, 1 3/4 on 10 years is to me, it's like 2.5%, 3% 10 years ago, because there's just so much leverage and debt tied to bond yields. So a 50 basis point move now with an extra 10, 20 trillion of debt on the planet over the last 10 years, it's a whole different animal. People have to look at it like that. So the big money question where the real alpha is going to be generated is because the Fed's never going to admit that, they're going to hold that tactical nuclear weapon in their back pocket. So that's why people are like, well, the Feds, in Fed speak, they're not really opening up the door yet to yield curve control. But I suspect if what you're saying is true, and we do have those types of deficits over the next 12 months, they'll get pushed into it a lot sooner than people think.
I don't know. I mean, the Fed as an institution, especially this Fed, not the Greenspan Fed, but the Yellen Fed, the Powell Fed. This Fed is very reactive. It's not proactive. They tend only to act when they're in extremis. So I tend to believe that yield curve control will happen somewhere between 2.25 and 2.5 on 10s. I think it's going to go higher. I think it's going to go significantly higher first before they do anything about it.
Yeah, you would think after the last decade they've become more proactive. They ruined our Christmas in 2018 with complete lies in the third, fourth quarter of 2018, and they said they pounded the table they wouldn't reverse. And you're absolutely right. The market, that beast in the market, that pressure broke them literally right around Christmas Eve, and it was just ruined. Like, how was your Christmas in 2018, Jared?
I don't remember, actually.
It was so bad, but it was a great chat. We should do this more often. I think the viewers, for young people watching us right now, I'm older, I'm a little older, but to have two veteran traders here in the seat sharing these conversations is very important for the young people watching us right now. Shout out, Jared, your Twitter handle, your book titles. How can people find you?
Sure. If you want to subscribe to the newsletter, go to dailydirtnap.com. That's dailydirtnap.com. My Twitter handle is @dailydirtnap. I got 2 books, Street Freak, which came out 10 years ago, All the Evil of This World, which is a novel that came out 5 years ago. And and you can listen to my radio show too, which is the Jared Dillian Show.
Excellent. Well, thanks for joining our Hot Mic series. I'm Larry McDonald, and we'll see you at the top. Thanks.